tonight, please help me give a warm welcome to Mr. Patrick Sheehan. We're about to learn about divorce, taxes, and the IRS.
All right, thanks everybody. Glad to be here tonight. Tonight we're going to talk about divorce, taxes, and the IRS. Everybody has a copy of my second book with the same name, and I've also brought a copy of my first book too. It's How to Permanently Solve Your IRS Problems. So how many people here love the IRS? Raise your hand if you love the IRS. Yeah. I love the IRS because, for several reasons. Number one, it drives business to my law firm, and that's exactly what I do. And number two, I think that we all want a strong IRS because then everyone pays their fair share. If we knew that we could be cowboys and Indians 1 month a year and cut deals, then perhaps we wouldn't pay our taxes and then the whole system would fall apart. Anyway, thank you so much for having me tonight. A little bit about me. I'm a former IRS attorney. I worked for the IRS for 5 years as an attorney. I own and operate the law firm called IRS Trouble Solvers, and all we do is help people that are in trouble with the IRS or the state of Illinois. When I was at the IRS, I reviewed offers in compromise. I was the guy at the IRS that said yes or no to every single offer in compromise at the IRS District Council level. And we have a tremendous track record of getting offers accepted in our law firm. I'm also the former director of the Loyola Tax Clinic. I worked there for 9 years and taught law students how to be tax lawyers and other stuff. So that's me. I also have an app. It's pretty cool. It's the IRS Attorney app. So if everyone wants to take out their phone right now and go to Android or Google and download our app, it's a lot of fun. You get to ask me questions if you like. There's connections to our blogs. You can even make a payment on it. It's a lot of fun. There's also something called the IRS Trouble Meter, where you can answer a series of questions and find out how much trouble you're in. So it's the IRS Attorney app on Google or Android. So before we start talking about the IRS and how to solve problems, let's meet the IRS. Who do we run into on a daily basis, or who do we not run into on a daily basis at the IRS? So there's service center representatives, those people you rarely talk to. There's IRS ACS. ACS is the automated collection system. And so it's essentially the computer system that's run by human beings or attended to by human beings. So when you call, you're going to get a different person every single time, which is really frustrating at times. A revenue officer is a local human being that has a lot of power over your case. And there's a couple local offices here. There's one in Schiller Park, there's one in Downers Grove, there's one in downtown Chicago. That's where the revenue officers reside. There's appeals officers. There's the appeals division within the IRS. And so, because this is America, if you can't get your way at the initial level, you get to file an appeal. And so if you file an appeal, that's where you'll go to. There's the criminal investigative division. Those are the people you really never want to talk to, or you hope you never talk to. Those are accountants with badges and guns. They have the ability to investigate, and then they make recommendations to IRS District Council, where I used to work, if they want to recommend a case for criminal prosecution. There's Office of Chief Counsel, that's where I used to work. The Office of the Taxpayer Advocate, that's where you can file a Form 911 and try and break through if you're having trouble getting through to a revenue officer or an appeals officer. There's the Treasury Inspector General for Tax Administration, you'll never speak with them. And the Commissioner, John Koskinen, of course, you'll never speak with him either. But that's the people at the IRS that you might deal with from time to time. It's harder to deal with the IRS nowadays because the IRS has lost 1/3 of its employees since 2010. And the IRS budget has been cut just a tremendous amount. So the IRS has been asked to do more with a lot less. For example, Obamacare, they were tasked with implementing Obamacare. The new tax law, they were tasked with implementing the new tax law as well. And so they're doing a lot more with a lot less money and a lot less people to do it. Okay, divorce and taxes. This is why we're here tonight. My typical divorce client is female. She's aged 35 to 55. She's either divorced or getting divorced, typically a stay-at-home mom. She has unfiled 1040 tax returns, but probably doesn't know it yet. A husband is self-employed and has employees. The husband has unfiled employment tax returns, and she learns about it when the IRS knocks on her door or takes money out of her bank account, or if she's working, takes money out of her wages. So let's tell a story now. My client, Chrissy, was a stay-at-home mom and raised the family. Her husband, Rocky, was self-employed. At the end of each year, Rocky would approach Chrissy with the tax return and say, "Here, sign this." Would cover it up, would actually not let her see it. And being a dutiful wife, she would sign it. Sometimes IRS notices would show up in the mail, and she would say, "What's this?" And he goes, "Don't worry about it. We'll take care of it." So unfortunately, the marriage didn't work out, and they got divorced. Because there was so little money in the divorce, she had to move out with her 2 kids and live in the basement of her parents' house. So when she filed a tax return after the divorce, the IRS glommed onto the refund. That was really the first time that she knew how much she owed. She owed over $100,000 on joint tax liability. And so in every case, and we'll talk about this in a little bit, in every case I obtain and analyze IRS transcripts of account. Who's on TDS? Everybody is on TDS? Do you get transcripts? Raise your hand if you get transcripts of account for your clients. Okay. In every single case, I insist on getting IRS transcripts of account because it shows me the IRS's side of the story. And so I got transcripts of account for Chrissy. It showed that she owed over $110,000, but also my computer program determined that the liability was probably dischargeable in a Chapter 7 bankruptcy. So even though she came to me initially with the idea of filing a request for innocent spouse relief, and I think she probably would have won, the bankruptcy was a better choice, I think, because not only did it get rid of her tax liability, but she also had substantial credit card debt stemming from the marriage. So when a client comes to you, if you do tax resolution, you have to look at the whole smorgasbord, if you will, of options that can help your client, and that includes bankruptcy. I don't practice bankruptcy, but if my client's eligible for that type of relief, I will make that recommendation. Okay, considerations in divorce on taxes. Who will take responsibility if the tax returns are audited? Who will pay if the IRS assesses additional tax liability? What if you already owe money to the IRS? What if you have unfiled tax returns? How many of you represent people before the IRS on tax resolution stuff? Okay, there's a small handful. How many of you have done installment agreements for your clients? Okay, same number of hands. How about penalty abatement? Okay, offers in compromise? Okay. How many of your clients have gotten divorced while you represent them? Half of your clients probably, right? A lot. So it can get sticky as a representative when you're representing both the husband and wife. And you may run into conflict of interest issues, especially if the divorce is acrimonious, and especially if there's IRS problems as well. Questions to ask your client, especially if they're getting divorced. Are all your returns up to date? Are all your returns filed? Now, do you file jointly or married filing separately? Did you review the tax returns before they were filed? Again, Chrissy, she saw the returns, but the husband put the hand over the tax returns and didn't allow her to see it. Do you recall signing the returns or the electronic filing form? A lot of times, especially with the electronic filing form, the husband will very badly sign the wife's name. It looks just like his signature, and you know it wasn't right. You still have a duty then, especially if there's a tax problem, you have a duty to make sure that the wife signed it or authorized him to sign it, which isn't legal, but it's still kind of an assent. Who in the marriage handled the preparation and filing of the tax returns? Who has the documents used to prepare the tax returns? And do you have copies of the past tax returns? These are a lot of questions to ask your client, but it's important in a tax resolution case that you ask these questions, especially if there is an unpaid liability on the tax return, because the IRS is going to want to know, did your client, especially in an innocent spouse situation, did your client know that there was an unpaid liability? Did your client take steps to see that it was paid, or did she ignore it? Did she rely on the husband to take care of it? Was she not given the opportunity to review the tax returns before they were filed? Of course, you know a joint and several liability means that both taxpayers are equally responsible for the unpaid liability listed on the tax return when it's filed, or subsequently if the IRS audits the tax return and assesses additional liability as well. This is really important too. Is there a business involved? Do you or your spouse own or operate a business? What I see a lot of times too is that the husband will make the wife the president and sole shareholder of the business in order to get women in business preference, or because there's a union involved and the union won't let the husband be the president of the business. And so she's great. She's got the stack of business cards, right? She's got the nameplate on the desk that she sits at once a month, maybe, just helping out. But then all of a sudden there's unpaid employment taxes, there's unpaid 941 liability. They're breaking up. And the IRS goes after who for the trust fund recovery penalty? They go after the president and the sole shareholder. And the husband's going, wasn't me, wasn't me. Is it a sole proprietorship or is it a corporation? That's a trust fund recovery penalty issue. If it's a sole proprietorship, you're responsible for both halves of FICA and FUTA, Medicare. You're totally responsible for the whole thing. If you're a corporation and you treat it properly as a corporation, then you're only responsible for the trust fund recovery penalty. Do you sell anything at retail? That's a tax question as well, because sales tax is also a trust fund type tax. Do you have employees? Are you a shareholder or officer? Do you have signatory authority in the bank accounts? Did you hire and fire? Did you sign tax returns? These are all factors that the IRS or the state of Illinois looks at to determine whether to assert the 100% penalty or trust fund recovery penalty against you. So if you're getting divorced, this is something that you should tell your clients. Protect yourself. Get copies of the tax returns. If these tax returns belong to you, and if they're in your house, the house belongs to you, get the copies of the tax returns. Get the underlying documentation. If it's electronic, copy it. Keep it in a safe place. Give it to your divorce attorney. Give it to your friend. Lock it in a box. Because you want to make sure that if there's a problem down the road, that you have the ability to defend the tax returns that were already filed. If a CPA prepared the tax returns, call up your CPA and say, I want a complete copy of my file, and I'm coming this afternoon to pick it up, and I will happily pay you for the copying charges. You just want to make sure that you get all of the information you need to protect yourself. All right, secure copies of the tax returns. Notify the IRS of a change of address. That's a Form 8822. Set up a P.O. box if that is helpful, especially if you don't have a regular place to live. Determine a list of assets, including any assets overseas and valuables. This is also part of the divorce because you want to make sure that your client is going to get their allocable share of any of those assets. Is there a safe deposit box? What's in it? And you also, if you've ever been to a bank that has a safe deposit, bunch of safe deposit boxes, they have a log, and so you can see who went in and when. You can ask for that information because it's your safe deposit box. But conversely, if your spouse goes in there and to see what's in there, the ex-spouse will know as well. All right. How do you find out from the IRS what is going on in your client's case? This is IRS e-services, and there's TDS, Transcript Delivery System. Like I mentioned earlier, in every single case, I get transcripts of account from the IRS. The client can't tell you what they had for lunch yesterday, let alone what tax returns are filed or what tax returns weren't filed. And so their story, most of the time, doesn't line up with what the IRS believes happened. So if you don't have transcript delivery system, sign up for it. It's a wonderful tool. And even for your tax return preparation, if you don't do any tax resolution, it's a good idea to see what's going on. You'll see if there's an open investigation. You'll see if there's any unpaid liability. You'll see if there's unfiled tax returns. This is what an IRS transcript of account looks like. And so it's the entire history of the case from the IRS's point of view. Very, very helpful. Especially for penalties, it'll show you if penalties were assessed. It'll show you the amount of the penalties. It'll show you the amount of the interest. It'll show you if there's any audits or any other open investigations. It's a very, very helpful tool that I recommend everybody take a look at for all of your clients. And you get to charge for it too. So I kind of already went over this. Obtain them in every case. There's different kinds of transcripts. There's regular account transcripts. That's the picture that I just showed you. There's income transcripts, which is really, really helpful, especially if a client comes to me and has unfiled tax returns. I get income transcripts. You can get them back for about 6 years. And they're very, very helpful because the client's records are often like this, and the IRS's records are often like this, and they don't match. So if you rely only on the client's records to prepare these tax returns, you're not doing your client a service, because then the IRS is going to come back later and question it. You can get line-by-line tax return transcripts online for the last 3 years. So for a new client, one that you've never done before, and they don't have copies of their last 3 years' tax returns, you can get those from the IRS. Security issues. It's harder to get transcripts of account. There's a double authentication system now, so when I ask for transcripts, my phone buzzes and I get a secret code on my phone that I have to put in. And that's a smart thing because of identity theft. When you call the IRS, you always ask for unmasked transcripts. If you don't ask for that, you're going to get masked transcripts, and masked transcripts are not particularly helpful, especially if they're income information, income transcripts. You always ask for unmasked. That's very, very important. Fax issues. The IRS is stopping faxing transcripts to you now. So it's really important that you sign up for e-services, because then they will put your transcripts into a secure mailbox that you can only obtain online.
Do you have to get permission from both taxpayers to do this, or what if one refuses?
If it's a joint return, then it doesn't matter.
Oh, it doesn't matter?
It doesn't matter, because that spouse that you're representing is entitled to her information, which just happens to be a joint tax return. There's some really neat software out there: Canopy for tax resolution, Pitbull, THS. Those are some really, really great programs. The program that I use is Pitbull. It's not as pricey as Canopy, but I like it better. And instead of, if you go online through irs.gov and order your transcripts, you have to order each one separately. And if it's 940s for 5 years, 941s for 5 years, you know, that's a huge number of transcripts. Where Pitbull will pull them all at once, actually all these, will pull them all at once and put it into one report. So it's very, very helpful. The 7216 disclosure, if you use anything online to get your client's information, you're supposed to have a 7216 disclosure. The 7216 is Internal Revenue Code section 7216, and it's just a paragraph that says, I authorize you, representative, to obtain my information electronically, understanding that it could be intercepted and used badly. So that's something that should be in your repertoire if it's not there already. Assessments. That's our Uncle Sam. We had him made for us. He's like one of our mascots. You'll see another one in a little bit. But an assessment. An assessment is the recordation of a taxpayer's liability in the books and records of the IRS. In my cases, it's the bright line, because if there's an assessment, it tells me I need to head in this direction. If there hasn't been an assessment, then I need to head in this direction. So in the old days, at the service center, there used to be a 3x5 card with your name on the top, and they would find it in the card catalog, pull it out, and next to your name, they would write the liability down. That was the assessment, the recordation of your liability in the books and records of the IRS. Of course, that doesn't exist anymore. It's all electronic. But the recordation of the liability is important, because the IRS can't collect money from you until there's first been an assessment. So again, when a client walks in the door, the first thing I'm listening for is, has there been an assessment? Have they gotten a bill, or is it a proposed bill? Because a proposed bill is pre-assessment, an actual bill is post-assessment. They can't collect on pre-assessment, but they can on post-assessment. So again, as you're listening to your client, you're already judging what you're going to do for the client depending on whether an assessment's occurred or not. So you're listening to your clients come in, got a stack of IRS notices, and you're determining if the case is a pre-assessment case or a post-assessment case. Can you have both in the same case? Absolutely yes. An already filed tax return and you get a bill, that's post-assessment. An unfiled tax return where no assessment has occurred, that's pre-assessment. So you can have them both in the same case. A notice of deficiency. Has anyone ever seen an IRS notice of deficiency? Yeah. That's a document where the IRS has thrown up their hands and said, you know, we're done dealing with you now, and so if you don't like what we're proposing here, sue us. And they literally mean sue us, because you have to file a petition, which is a fancy word for a lawsuit, in the United States Tax Court. That's all pre-assessment. So Mike and Norma, they hadn't filed tax returns for several years. They went to a tax return preparer and took along a big box of documents. You've all seen that, right? Big box of documents. And they didn't, and the tax return preparer did not obtain IRS income transcripts of account. That was a big mistake. The tax return preparer only relied on the box of documents. Of course, a couple of W-2s and 1099s weren't included, and the IRS got a love letter, or sorry, the clients got a love letter from the IRS because it didn't match. So this is where IRS transcripts of account are real important. In this case, kind of ended badly because not only did the IRS question the unreported income, but because the accountant or the tax return preparer didn't do his job and get the IRS income transcripts of account, the IRS started questioning other areas on the tax return that would have never been questioned had they done their job. So it's really important that you get income transcripts on unfiled tax returns. All right, compliance. This is our other mascot. He's a revenue officer. So compliance is important. The IRS will not listen to me. They will not consider a resolution unless you're in compliance. What does compliance mean? Compliance means that all unfiled tax returns have been filed. You need to be a good taxpayer going forward. That means making estimated tax payments in full and on time, or federal tax deposits if you're a business. The IRS will not consider a resolution without it. The C2K. C2K stands for Compliance 2000. That's a very little known IRS policy where the IRS can choose to not demand the filing of tax returns that were due greater than 6 years ago. So as of today, 2012 and earlier fall into Compliance 2000. So when a taxpayer comes to me, and we just had one this week, taxpayer came to me, hadn't filed 12 through 18. So the tax return preparer prepared 12 through 18. 12 was a great year for my client, owed $80,000 per return, 80,000 bucks. So we pull the IRS income transcripts and we pull the regular transcripts. The income transcripts were blank because my guy's self-employed. The 1040 transcripts were blank because he hadn't filed and there was no open investigation. So we turn around this Compliance 2000 policy and weaponize it against the IRS, where my client now chooses to not file 2012. He'll file 13 through 18 only and not file 12. Now, the difficulty with Compliance 2000 is that this is a policy. It's not the law, and the law conflicts with the policy. And so I can't recommend to someone that they not follow their known legal duty, which is to file all tax returns that you're required to file. That's like me as a lawyer saying, it's okay to speed, right? It's not okay to speed. And I can't, as an attorney, advocate something that's illegal. So I can't tell a client that it's okay to not file a tax return, but the client, being a grown-up, can make the choice to not file it, understanding a couple things. Number one, that the assessment statute of limitation never begins to run on an unfiled tax return. The IRS can come after him at any time in the future, but because I got those transcripts that we're talking about, the income transcripts show nothing, the regular transcripts don't show anything, the IRS is completely asleep, and so the client just saved 80,000 bucks plus penalties plus interest by using this IRS policy against the IRS. So that's a real big deal. A lot of CPAs, how many have heard of Compliance 2000 or just that policy? Yeah, not many of you. A lot of tax return preparers will just automatically prepare all the tax returns because that's what the client asked without considering the consequences of that. And in this situation, an $80,000 swing plus penalties plus interest, that's the difference between financially devastating a client forever, for the next 10 years anyway, or getting into a manageable installment agreement, which we're able to do because 13 through 18 wasn't as bad.
Yeah.
Yes, sir.
Do those, does that program apply to anything beyond income tax returns?
It only applies to 1040 tax returns. It does not apply to corporate tax returns or 941s or 940s. So, in this very case that we're talking about, the guy's corporation didn't file 1065 for 12. Compliance 2000 doesn't apply to that tax return for 12. But if he files the 1065 for 12, it identifies him as the owner, right? And so that would wake the IRS up. So in this instance, he's also choosing to not file the 1065, understanding that compliance 2000 doesn't apply. But because it's so old and the IRS is asleep, the chances of the IRS waking up are really, really small. Okay, what are the options that may be available to a divorced taxpayer with unpaid IRS liability? The options include innocent spouse, injured spouse, different types of installment agreements, a regular installment agreement, a partial payment installment agreement, currently not collectible, a request for penalty abatement. There's two different types we'll talk about, an offer in compromise, and bankruptcy. So let's explore each of these. Let's explore each of these in turn. All right, there's three different types of innocent spouse relief, and we're not going to delve too deep into them, but the first one is classic innocent spouse relief. And this type of provides relief from an additional tax a spouse owes stemming from a married filing joint tax return. If the other spouse or former spouse failed to report income, reported income improperly, or claimed improper deductions or credits. Then there's separation of liability. This type of innocent spouse relief is eligible, again, for married filing joint tax returns when an item wasn't properly reported on the tax return. This type of relief, if granted, separates the liability and allocates the additional tax owed to the spouse at fault and absolves the spouse that's not at fault. If you're not living with this person or you're legally separated, that's very helpful. The third type is equitable relief. Equitable relief is kind of like a last-ditch effort. If you don't meet the first two types, and there's a statute of limitation on the first one, I think it's 2 years from the first time you're notified of collection activity. Equitable relief is any time during the 10-year collection statute. It's kind of a last-ditch effort where if you don't meet the first two criteria, then you can ask for equitable spouse relief. Injured spouse. A lot of people come to me and say, I want injured spouse. That's different from innocent spouse. Injured spouse is where you file a joint tax return with someone and the IRS keeps the refund that was allocable to you. And so you ask the IRS to refund the allocable portion of the refund to the spouse that created that refund. So here we have Heather, who had been married and divorced before, married her high school sweetheart who had also been married and divorced before. The thing is, John didn't tell Heather that he had a tax problem when they got married. And so they filed their first joint tax return together. She made more money than he did, and there was a really nice refund on that tax return. So she went out anticipating that she was going to get this nice refund. She went out and bought a couch, she bought a computer, all in credit because she was going to pay it back right away, right? And all of a sudden the IRS grabs the refund. And so Heather was understandably upset with John for not being truthful to her. And so we applied for injured spouse relief, where we asked the IRS to give her the allocable portion of the refund that she generated. It takes a while. It takes a good 6 months, 6 to 8 months to do that. And it was a sizable refund because otherwise why would you pay me to try and do that, right? So, but there's injured spouse relief. All right, how are we on time? We're doing good on time. Any questions? And we're going to take a little bit of a break here.
I think the IRS is disagreeing with you.
The tax gods.
Ever since he mentioned the IRS being asleep.
Can't wait. Woke us up.
Anyone have any questions so far? Yeah.
How many years can you get transcripts? How far back?
Account transcripts, you can go back as like 1990. You can go back to 1990. Income transcripts are typically 6 years, maybe 8 years, depends on what it is. The IRS purges their system after a bit, which is good for us. Because if they're purging income transcripts, then we know it's not likely that the IRS is going to come after an old tax return.
Do they ever charge for those? Is there a fee?
Do they charge for transcripts? Bless you. Do they charge for transcripts? No. No. You just sign up through e-services, and it takes a long time, about 45 days after you sign up, and then you can access this information electronically. Any other questions for now? Okay. We'll reconvene in about 10 minutes, okay? Thank you. Our tagline for many years used to be, call us before the IRS calls you. And we loved that line until the scammers goofed it up. And now the IRS says, we won't call you. We'll send you a letter first. So if you get a phone call, you know it's a scam. So we had to get rid of that one. All right. Installment agreements. People call them pay plans. There's a number of different installment agreements that we're going to talk about tonight. So a war story. We have Victor and Tess. Tess met Victor online. Victor was a European immigrant, 15 years younger than her. And so they got together, they got married, and Victor went to Tess and said, I have friends who I owe money to. Would you please give me money so I can pay my friends? So she, as a good wife, took all the money out of her IRA in cash, cashed it out, gave it to Victor. Victor paid his friends. So comes time to file a tax return. This was an IRA. She had a substantial tax liability. So she got the tax return prepared and went to Victor, and Victor says, this is not my problem. I don't want to sign this tax return. So ultimately, he did sign the tax return, and we're getting them into an installment agreement. But when you just see that really shady fact pattern, you know, it troubled me quite a bit. But we're working on an installment agreement for them. So there's thresholds that the IRS gives you installment agreements for. Number one, liability less than $25,000, exclusive of accrued penalties and accrued interest. So if you owe less than $25,000, you can get into an installment agreement without a financial statement. You don't have to fill out a 433A. You don't have to fill out a 433F. You just have to be in compliance, meaning all tax returns are filed, and you can get an installment agreement pretty easy. If you owe exactly $25,000, a monthly payment would be right around $525 a month. Here, you can make the payments to the IRS manually, meaning you can write a check to the IRS, or you can go online and pay via irs.gov, or if you want to put it on your credit card, you can do that. Later installment agreements that we'll talk about require direct debits. The other way you can have an installment agreement payment made is you can go to your employer and have them take the money out on a monthly basis as well. Liability less than $50,000, exclusive of accrued penalties, accrued interest. Again, no financial statement is required, but you have to make your payments via direct debit. And to do that, you have to fill out a Form 433D. It's called a 433D installment agreement, and you have to send that to the IRS with the amount of money that you want to pay. They take the money directly out of your bank account. Now, all of these installment agreements that we're talking about contemplate the full payment of the entire liability, including penalties, including interest. That doesn't mean you can't circle back around later and try and negotiate the reduction, either in penalty abatement or if you are eligible for an offer in compromise. Just because you file and you're in an installment agreement doesn't mean you're married to that resolution. You can also do other things as well. A lot of times when we have a revenue officer who's really hot under the collar and is seizing stuff, and we get into an installment agreement first, and then after the ship is level, then we circle back around and seek a different type of relief, usually penalty abatement. All right, liability less than $100,000. You still don't need to file a financial statement with the IRS if the case is assigned to IRS ACS. Those are the humans that are manning the computer system. If your case is assigned to a revenue officer, this policy doesn't apply. The revenue officer will always demand the filing of a financial statement, a 433A or a 433F. This is easier to obtain, or it's not that hard to obtain these, and you don't have to show your financial condition. I personally don't like to show the financial condition of my clients, because if you have, say you have a self-employed client and they have $50,000 in the bank, but that $50,000 is used to buy widgets or hamburgers or whatever it is they do, the IRS will say, we want that $50,000 as a down payment. So here, I don't like to disclose my financial condition to the IRS. So again, if your case is assigned to a revenue officer and you owe between $50,000 and $100,000, they're going to ask for a financial statement. If you owe more than $100,000 to the IRS, you will have to file a financial statement, a 433A or a 433F with the IRS. And you're also subject to IRS national standards. IRS national standards is where the IRS says, you're entitled to housing and utilities, but you have to be within a certain dollar amount. And so you can find it on the IRS website. So if you live in DuPage County and you have a family of 4, there's a certain dollar amount that you're required to live within those standards. If you are in excess of those standards, and most people are, that doesn't mean you have to move. It just means that for purposes of the mathematical calculation that is an installment agreement or is an offer and compromise, the IRS is going to disallow the difference between what you're paying and what the IRS thinks you should be paying. Same thing with a vehicle. If you own a vehicle, I think it's $407 a month right now. And so if you're paying more than $407 per month for a car, either to lease it or to own it, the IRS will disallow the difference for purposes of the mathematical calculation. We had a client named Rosalind who had a severely disabled daughter named Jennifer. Rosalind's husband was not a very nice person. He was an alcoholic. He didn't help care for Jennifer. And so Rosalind had to carry the burden of caring for Jennifer. Jennifer had a lot of, she was profoundly disabled, and so she had a special car. There were special ramps to get into the house. The house had to be a ranch because she couldn't navigate stairs. The medical expenses were really large, but she also, Rosalind had a big tax liability too. The IRS, the revenue officer we were dealing with, wanted to impose national standards. And so the car, it was way more than $407 a month. We're not going to allow that. The housing, we're not going to allow that because it's too high. The special bed that you have to pay for to allow Jennifer to sleep in it, we're not going to allow you to pay for that. It was like, really? Are you kidding me? So because this is America, and there's a series of appeals that you can file, we went above the revenue officer's head, showed pictures of Jennifer, showed pictures of all the cars, and it made sense to this person. And so we finally got our way and got her into a reasonable installment agreement. So again, fight for what is right for your client. Don't take what the IRS is willing to accept. Fight for your client, because 9 times out of 10, you can get what you need, you can get what you want, and get a reasonable installment agreement or offer and compromise or whatever it is you're seeking from the IRS if you fight. Don't just stand there and take it. Fight for your clients. All right. How do I quickly calculate monthly installment agreement payments? What I do is I take, there's 2 different types of installment agreement terms, durations. There's a 5-year plan and a 7-year plan. So for the 5-year plan, you divide it by 48 months, and that's the extra year is to pay for penalties and interest. Okay, so you divide it by 48 months, and that gives you the rough amount that the IRS might be willing to accept without the filing of a financial statement. Same with a 7-year plan. You use 72 months. Again, that extra year is to accommodate for penalties and interest. This calculation will give you just a coffee table number of what the IRS might be willing to accept under an installment agreement without the filing of a financial statement. This number will always give you a higher number than the IRS is willing to accept, but I use this because I'm testing my client. If the client says, yeah, I can handle that number, then I can come into and negotiate a lower installment agreement payment, and now I'm a hero to my client because I came in for less. But it gives you a rough coffee table number. All right, all of these installment agreements contemplate the full payment of all of the liability, including penalties, including interest. So here in a divorce situation, you want to get into an installment agreement. Can you get into an installment agreement if you have unpaid joint liability to the IRS with an uncooperative ex? My client Marie, who was self-employed, had joint unpaid liability for the period that she was married to her now ex. And then she also had an additional unpaid liability for later years. And so we called the IRS to attempt to negotiate an installment agreement for the whole thing, the joint liability and the separate liability. And the IRS said no, because we want the ex's permission to grant an installment agreement for the joint liability. Of course, the spouse is uncooperative. He's not going to consent. And I, as an attorney, also had an ethical issue, because am I negotiating an installment agreement for a non-client or for my client? So I have a little difficulty there. And so what we ended up doing is we ended up splitting the liability, or mirroring the liability. That's where you ask the IRS to take the joint account and to split it into two. That doesn't mean that there's half is here and half is here. What they do is they take the joint account and zero it out, and then they create two separate accounts that mirror each other. So if there's $100,000 due here jointly, they zero that account out, and now we have two accounts, each with $100,000. And so because they mirror each other, if one spouse makes a payment, the other spouse gets the credit for it, because it's a joint and several liability. So we asked the IRS to mirror or split the accounts, and when that was done, we finally got into an installment agreement for Marie, not only for the joint liability, but also for her separate liability as well. That liability can only be paid once. That $100,000 can only be paid once. So if one spouse pays it, the other spouse gets the credit. Even though there's $200,000 on the books of the IRS because of the split, it can only be paid one time. There's something called partial payment installment agreements. A partial payment installment agreement is where the payments are smaller, or token payments. I just got one this week. Guy owes over $100,000. We filed a financial statement. The IRS imposed the national standards, and at the end of the day, they can only pay $25 a month. And so that's what the installment agreement reads, $25 a month. That's a partial payment installment agreement. It will never, ever pay that liability in full. Penalties and interest continue to accrue. But this is the second or third time for the same client. You'll come out of currently not collectible, we'll talk about that in a second, or partial payment. You'll come out of those agreements after 1 to 2 years. The IRS usually sets a 2-year time frame, because they kick them out of that status and want to see if they have the ability to pay. And if you do it long enough, and that's going to happen in this case, the collection statute of limitation drops off. The IRS won't be able to legally collect this money anymore. And so I refer to that as a poor man's offering compromise, because $25 a month times the remaining collection statute, let's call it 2 years, that's a bargain. And especially he owes over $100,000. Currently not collectible, or temporarily uncollectible. That's where you demonstrate to the IRS with a financial statement that you have zero ability to make any payments to the IRS at all. And so the IRS will accept no dollars per month if they deem you uncollectible. Again, penalties and interest continue to accrue, but the statute continues to run. The collection statute continues to run. I had a client a month ago, $150,000 dropped off on the collection statute of limitation. So the IRS does allow these to drop off.
How long does that go? Doesn't it drop off every year? Or
How long is the collection statute? The collection statute is 10 years from the date of assessment, absent any extensions. Extensions include bankruptcy, offer and compromise, request for an installment agreement. So pretty much any time you ask the IRS for some sort of relief, the 10-year clock stops. And it doesn't start again until you withdraw your request for relief is granted, it just doesn't start to run again. And in a way that's fair because you're asking the IRS for relief, so the game clock stops while they consider your request for relief, and then the game clock starts again. But each year, typically, if they're filed on time, has a separate 10-year clock. And so the earlier ones will fall off sooner, the later ones not so much.
So what would be the advantage of asking for an offer of compromise or installment agreement that's going to drop off after 10 years?
What's the advantage of asking for an offer if the collection statute's about to expire?
Just let it expire.
Correct. We have another client where we're in a partial payment installment agreement. They owe over $200,000. The IRS has taken $2,000 a month under an installment agreement, but it's still only a partial payment installment agreement. And the statutes on the earlier years, which are the bigger years, are going to drop off before that 2 years revisit period expires. So again, a poor man's offer and compromise. You pay $24,000 in the next 12 months, and the statute goes, that's way better than an offer and compromise or full payment. I can't emphasize the importance of compliance. The IRS will not talk to you until you're in compliance if you have an unpaid liability. That means filing all your tax returns, paying your estimated tax payments currently or your federal tax deposits currently. You have to get into compliance, otherwise the IRS will not talk to you. Now what happens if your ex-spouse negotiated the installment agreement and the liability wasn't split? Well then, if your ex-spouse negotiated it and asked the IRS for permission to include you, you're enjoying the benefit of this installment agreement because he's making the payments and you don't have to. But because it's a joint and several liability and because you had to give permission for this installment agreement, you're on the hook for that installment agreement if he doesn't make those payments. The problem with that type of an installment agreement, I refer to it as allowing the tail to wag the dog. Because in this situation, if he stops making the payments, then you're on the hook for the payments. And then if you don't, you default the installment agreement. Okay, partial payment installment agreements, that's a PPIA, and CNC that's currently not collectible status are typically revisited after 1 or 2 years, or if you don't file a tax return because you're not in compliance, or if you file a tax return that lists an unpaid liability, or if you make too much money, because the IRS typically sets a tolerance in the computer. So if you make above a certain dollar amount, then they're alerted to the fact that you might be able to pay now and they kick you out of that status. The thing I don't like the way they kick you out of this status too, and I'm getting a lot of clients that this is happening to, they send you a notice of intent to terminate your installment agreement. I've been making my payments and here's proof. The IRS does it very inelegantly. They should send a letter saying, 2 years is up, time to revisit. Instead, they just default your installment agreement and the taxpayer's befuddled. All right, Annette. Annette was married to Alan for many years. Annette and Alan had a substantial liability due to the IRS. That was joint and several. They got divorced. The divorce was a bad one. So Alan, though, under the divorce decree, said, it's my responsibility. He negotiated an installment agreement with the IRS, got Annette's permission, and she enjoyed the fact for a couple years that she didn't have to make these payments. Alan, on the other hand, got a new girlfriend and started traveling a lot internationally, and Alan started allocating his dollars elsewhere. And so unfortunately, he stopped making the payments under the installment agreement. That caused the installment agreement to begin to default. Annette then had to start making the payments even though she wasn't supposed to, which required her to go back into the divorce court and sue Alan again and rehire a divorce lawyer and pay all that money to the divorce attorney to get him to honor his obligations. Penalties. Penalties, the bane of our existence, right? This is one of the most asked questions I get every day. I'm willing to pay the tax, maybe I'm willing to pay the interest on the tax, but I don't want to pay those penalties. They're terrible. Well, penalties are punitive. They're designed to groom compliance behavior. That's what a penalty is supposed to do. But you've seen penalties are awful. They're terrible. And they just add so much to the bill. So we can get rid of penalties. Number one, you have to be eligible for penalty relief. We'll talk about that in a second. And you have to ask for this relief. How do we do that? This one is a real wonderful trick, and not many people know about it. Have you ever heard about the first-time penalty abatement? Yes? The first-time penalty abatement program. To be eligible for this, the 3 years preceding the first year in which you have an unpaid liability have to be perfect. So you have to have filed on time, you have to pay on time, you can't have a nickel of penalties assessed. If those 3 years preceding the first year that you're seeking this relief are perfectly clear, you can ask for first-time penalty abatement. First-time penalty abatement only applies to failure to file and failure to pay. It doesn't apply to any other penalties. But you know the failure to file is an awful penalty. Failure to pay is a big one too. So you have to be eligible. The 3 years preceding have to be perfect. It's first time the first year and only one time. And it's really a substantial benefit to your taxpayer. But it's only for the 1 year. And this is one of the few things you can do on contingency. Most of our work, virtually all of it, you can't do on contingency. This one you can charge a contingency fee. Request for penalty abatement based upon reasonable cause. This one covers all of the years in which you have unpaid liability and for which penalties were assessed. This must be in writing with underlying documentation. For example, if there was some sort of arrest, if there was domestic battery or something like that, a police report is helpful, pictures are helpful, an insurance claim is helpful, medical reports, a letter from your sponsor if you're in GA or AA. We'll talk more about that in a second. Every 7 years, approximately, the pendulum swings at the IRS back and forth. Really easy, really hard. Really easy, really hard. Well, guess where we are now? We're in the really hard part. And so I tell all my clients to expect a no every time we file a request for penalty abatement based upon reasonable cause. And we get a lot of no's. But because this is America, we can file an appeal. And that's where we get traction. We get traction at IRS appeals. But still, you can have a great fact pattern, but still not get all of the penalties abated. At appeals, we expect about half of the penalties to be abated, but it takes such a long time. All right. Spousal abuse. So Thomas sold insurance. It was his insurance agency. His wife, Denise, helped out by answering the telephone. Thomas was not a nice guy. Thomas had all of his commissions paid to Denise under her name and her Social Security number, even though she didn't do any of the work. When it came time to file the tax returns, Thomas gave her a married filing separate tax return for her, and he filed a married filing separate tax return with no tax due. And so they came to me with this huge tax problem. You can only imagine there's conflict of interest issues here, and who am I representing and how do I advocate for one against the other, but you're married. And so I started to point this out, and Thomas didn't like that and fired me. Yeah, it was pretty awful. So the classic request for penalty abatement, fact patterns that don't work, downturn in the economy, loss of an important customer or client. I didn't know I was supposed to file tax returns. I didn't know that I was supposed to make federal tax deposits. I forgot to file my tax returns. None of that really works. What does work is fire, flood, illness, injury, death, something bad that happened to you that knocked you off your normally good tax-paying duties, and when that bad thing went away, you became a good taxpayer again. So things that work, death of a friend or family member also works, theft, personal or business. I had one case where the roof caved in on the client's manufacturing facility, and so that was penalty abatement right there. Addictions, gambling, alcohol, and drug addictions. I asked this question at every single new client interview. And normally I'm scribbling notes, I'm looking down, I'm not looking at the taxpayer. But for this question, I always look in their eyes. And if it's a husband and wife, you always look and see how they interact. Because a lot of times, if people lie, they look down and to the left. Did you know that? When people lie, they typically look down and to the left. I just make a note. I don't bust them on it or anything like that because I could be wrong. But when you go through their credit card statements, when you go through their bank statements, If they're at the same ATM every day, you Google the address of that ATM. Guess where it is? It's inside of a casino. If they're at the liquor store every day, you know, famous liquors or whatever, if they go there every day, now you know they got a problem. So you can back into this and then confront them later if it's appropriate to do so. So if you're asking for penalty abatement, you need to have a good fact pattern. And you need to have underlying documentation too.
How do you prove like objections to the IRS? I mean, what are you going to send them? The ATM stuff? I mean, it's hard to say. Somebody said that they had an alcohol problem and I didn't file tax returns. I mean, what am I going to say? They had an alcohol problem?
Okay, so what do you say in a request for penalty abatement? First of all, let's use the gambler. So if the guy has a gambling addiction, the IRS is not going to be sympathetic because he's using the money that he should have paid to the IRS to go have fun. So you have to have him self-exclude himself from the casino. So if he goes on the casino property, he will be arrested for trespassing. He needs to go to Gamblers Anonymous. He needs to have a sponsor there. He needs to go to seek medical treatment perhaps because they have medications for that. He needs to stop gambling. If he's not willing to stop gambling, I can't help him with the penalties. Same thing, alcoholics. Alcoholics need to seek rehab. And so these are the documents that I'll attach to my request for penalty abatement. And this bad thing that we're pointing at has to line up from a time frame. So if you were an alcoholic in 2002, but I'm asking for penalty relief for 2018, it doesn't work. The timing has to be the same. But the bad behavior has to stop. I have to demonstrate that the bad behavior stopped, and then I can go to the IRS and ask for this type of relief.
You know, the other problem I have with these people, you try to get penalty abatements. If they can't pay the IRS, then that means they can't pay me.
That's why God invented retainer fees.
Oh, okay. They can't pay them, they can't pay me.
So when I ask the question at every meeting, so again, if I'm with just one taxpayer, I look them in the eyes. If it's a husband and wife, I always look and see what both of them do, because do you have a gambling, alcohol, or drug addiction? And he goes, no, and she goes, like this, you know, so I know that there's something there. And again, when do I start to talk about it? At the appropriate time is the answer. Might not be right there. Offers in compromise. Everybody wants one. Very few people are eligible for an offer in compromise. An offer in compromise is where you cut a deal with the IRS. There's three different types of offers. There's doubt as to collectability, doubt as to liability, and effective tax administration, ETA, or hardship. Most people are not eligible for an offer in compromise. First, you need to be eligible for one from a compliance standpoint. Again, all your tax returns have to be filed. You have to be current with your federal tax deposits or estimated tax payments. You're not eligible to file if there's any unfiled tax returns. Let's go back to our guy with 2012. That $80,000 problem for 2012, he's choosing to not file that tax return. He's not eligible for an offer in compromise because he owns a couple pieces of property, he makes some good money. So he's not eligible for an offer in compromise. But if he was eligible for an offer in compromise, then it would be a client choice whether to file that tax return for 2012, get it out in the sunshine, get the IRS to cut a deal on it, and include it in the offer. Because if we didn't get it out in the sunshine, if he chose not to file that tax return, remember the assessment statute of limitation has never begun to run. The IRS can come after that tax return after the offer is in compromise is accepted and paid. So these are the strategy decisions that you need to come address. Let's start with the one that is the least frequently granted, effective tax administration. This is a real tough one to get. Let me give you a fact pattern that I had. Her name was Sandra. She was an elderly taxpayer who owed $1 million to the IRS, $1 million. Problem was, she had $1 million. And so from a strict regular offer and compromise standpoint, the IRS would say, pay us the $1 million, right? And then the problem solved. But in that situation, she wouldn't have a roof over her head, she wouldn't have any food to eat. And so let me complicate her case. She was blind, She was a double amputee because she had diabetes. She was on the kidney transplant waiting list. It was just an awful, awful fact pattern for her. And so I went to the government with an offer and compromise based upon effective tax administration. I offered between $300,000 and $400,000, figuring that she would still need the rest of the money to live on. The government said no. Do you believe that? The government said no. And you couldn't ask for, it's a terrible fact pattern for her, but for me it was a great fact pattern because I thought that I had a decent chance for an ETA offer. The government said no. Doubt.
Did she get to file appeal?
Did we file an appeal? Yes, we filed an appeal, and the appeals officer said no. The deal I was working on with the appeals officer was we were going to use that $300,000 to $400,000 that we were willing to pay the government. We were going to buy an irrevocable life insurance policy for $1 million. And so when she dies, then the government would get their $1 million. The government didn't even want that either because they didn't want to wait. So I was really disappointed in that case. Doubt as to liability. This is also infrequently used. Doubt as to liability is where you go to the IRS and you say, government, I don't owe you what you're asking for. And so you need to take less because I don't owe you what you're asking for. There's other options generally available first. Audit reconsiderations, offers and compromise. And so we don't use this very frequently, but you do need to file, you do not need to file a financial statement because you're not arguing I can't pay, which is the next offer and compromise. You're arguing I don't owe you this money. This is the one where 99% of the offers are filed. Doubt as to collectability. Government, I can't ever, ever, ever pay you what I owe you, and therefore you should accept less. So you need to file a financial statement with the IRS. The financial statement, again, is where you disclose your income, your assets, your expenses. If you own a business, you have to file a 433B, again, disclosing the income, assets, everything. And so the government is going to determine your ability to pay. Under this type of offer and compromise, there's two ways that you can pay. Number one is a cash offer and compromise. And so the government gives you 5 months from the date they accept your offer and compromise to pay all of the money that you promised to pay under this type of offer and compromise. The other one is 24 months. You have up to 24 months to pay. So you take the amount that you offer, you divide it by 24, and those are the payments that you'll make. Under the 24-month, the IRS uses a different calculation. You're going to pay more under this type of offer and compromise than you do under a cash offer. One of the things that the IRS looks at, too, is how much time they have left on the collection statute. If the IRS doesn't have much time on the collection statute, they might be more willing to accept an offer and compromise, because if they still have 10 years left on the collection statute, they might be less willing to accept an offer because they might say, why should I accept this smaller amount today where I have 10 years to collect from you and maybe you'll make more money in that 10-year period. So it's a business decision, essentially, that the IRS is making. Offers and compromise nationally, there's about a 36% acceptance rate. And so most offers are not accepted. At IRS Trouble Solvers, our acceptance rate is about 96%. And that's because we do all the work beforehand to make sure two things happen. Number one, is my client eligible for an offer and compromise? And number two, if they are eligible for an offer and compromise, can they pay? Can they fund an offer and compromise? Because if those two factors don't exist, what are you doing? You're wasting your time. Pre-offer planning. And that's why our acceptance rate is so high, because we do all the work beforehand. If you look at the offer form, it's simple. You check a few boxes, you type in a number, you file it, right? It's the worst possible thing you can do. So Tom, who was an attorney, he came to me and he owed over $100,000. And just from a strict number standpoint, without any pre-offer planning at all, he wasn't eligible for an offer and compromise. Problem was, he drove a beater car. He lived in a rinky-dink little apartment. He had terrible mouth problems, teeth problems. And so with pre-offer planning, He went out and bought a new car. He got his teeth fixed. He lives in a nicer apartment. Now he's offer eligible. And so we used, he's offer eligible because those national standards, right? So say he was entitled to $2,000 for rent, but he was only paying $500 because he lived with a friend. So now we get him into an apartment for $1,999. It's within that threshold. He was driving a beater car, so we bought him a new car. So he bought a Volkswagen, a brand new Volkswagen at $407 a month. So he enjoyed a new, bigger house. He enjoyed a new car. He got his teeth fixed, and we settled for about $8,000. That's where pre-offer planning is so important. All right, other issues to consider. Is your client under levy? Is your client under levy? I frequently get a call on a Thursday afternoon from a client, potential client, and they say, we just got levied on and we have to make payroll tomorrow. What can you do for me? It's like, I can tap dance pretty good, but I don't know if I can tap dance that good. And so if you can demonstrate to the IRS that it's going to be a hardship, that you can't make payroll tomorrow, and if you can't make payroll, you're going to go out of business, and if you go out of business, you, government, aren't going to get paid, then they'll partially release the levy. They won't release it all. They'll partially release the levy so that you can make payroll the next day. Bank levies. A bank levy is where the government takes all of the money out of your bank account, every single penny. And that's financially devastating. It gets their attention, doesn't it? And then you say, well, how do you get paid? That's why God invented retainer fees. Wage garnishments. Wage garnishments are continuing, and the government pretty much gets all of the money that you're being paid except for the value of your dependency exemptions. And so that's financially devastating too. The government can levy on Social Security benefits, and they do. They're limited to 15% unless they ask for managerial approval to go more than 15%, so they can actually go greater than 15%. Federal tax liens. Federal tax liens are notice to the world that you have a tax problem. It also affects your ability to buy anything, cars, real estate. If you own real estate, it affects your ability to sell it. Right now I have a client, she owes about $80,000 to the IRS. She owns a condominium worth about $60,000, and she wants to sell it. Well, guess who's going to be at the closing with their hand out? The government will be. But the problem here is that the proceeds of sale, after you deduct all the costs and everything, she sells it for $60,000. There's cost of sale and everything in there. It's not enough to pay the IRS in full. So you have to ask the IRS for permission to sell this property. It's called an application for certificate of discharge of property from federal tax lien. Think of a tax lien as like a cloud over everything that you own. So your car, your house, your bank accounts, it's a cloud over everything. And so what you do is you ask the IRS for permission to sell this, where you take the house out from underneath the cloud. The cloud still stays there because she's still going to owe $20,000. You take it out from underneath the cloud, and now you can sell the house. The government will get the proceeds, and then we'll get her into an installment agreement for the remaining $20,000.
If they put a tax lien and you owe a huge mortgage, can the mortgage company cancel the mortgage or call the mortgage if they put a lien on it?
Can the mortgage company cancel the mortgage if the IRS files a federal tax lien? No.
They can't.
It's a contract. So unless the contract specifically allows the mortgagor to cancel the contract, and I've never seen that, then no. And it's first in time, first in right. The mortgagor is ahead of the IRS in terms of priority. So if the mortgagor is still getting their monthly payments, they don't care.
Okay.
And at the closing, under this hypothetical, if there was a mortgage at the closing, the senior lienors, the mortgage company, would be paid, and then anything left would go to the IRS.
So they're in priority. The mortgage is always priority.
Yes. As long as it's a properly recorded mortgage, yes.
So the IRS may never did anything if they put the lien at the book one.
Correct. But even in that situation, let's say that there was $0 available at the closing to go to the IRS. You still have to ask for permission to remove the house from underneath the tax lien. because otherwise the tax lien will attach to the property and the new purchaser doesn't want that.
Oh, okay.
Statutes of limitation. There's refund, collection, and assessment statute of limitations. The assessment statute of limitation never begins to run until you file a tax return. Once you file a tax return, the IRS typically has 3 years to assess additional liability against you. Because this is America, there's exceptions to every rule. And so if you have a 25% or more gross omission of income, then the IRS can assess 6 years. Fraud or evasion, they can assess forever. They can come after you forever. The refund statute of limitation. If you don't file a tax return within 3 years of the due date or 2 years from the date the tax is paid, the government gets to keep the money and it doesn't go anywhere. You lose out. I had a client that would regularly pay, just guess at the number, just send in checks because he knew he owed. And then he thought of it in his head as like a savings plan. I'm going to get my money back. When we filed the tax returns, he lost $120,000 because he sat on his rights. And then the collection statute of limitation is 10 years from the date of assessment plus any extensions like offers and compromise bankruptcy. Audit issues. How many represent their clients in audits? Yeah. And then there's business taxes. There's the trust fund recovery penalty. We kind of touched on that a little bit earlier. And then there's bankruptcy.
And on the 10-year statute, does that get extended if there's a lien?
Does the 10-year statute get extended if there's a lien? No.
10 years to collect and that's it.
10 years to collect, absent any extensions, and that's it. But I do have, the IRS can sue you within the 10-year period to reduce the claim to judgment. And if they do that, now there's an additional 20 years tacked on. So the IRS can actually collect for 30 years. So the fact pattern here, really interesting case. My client owes $500,000 for 2005. There's only a year left on the collection statute. The revenue officer calls her up and says, hey, we see you have an interest in this house, this property that you own with your husband. Oh, we're divorced. We're divorced. We're not married anymore. And the divorce decree, legal document, right, says that I have to quit claim my half interest to him pursuant to the divorce decree. So the revenue officer, being a really nice revenue officer, says, well, you better run down to the courthouse and record this quit claim deed that you forgot to record, or that you said you didn't record. So she runs down to the courthouse, files the quit claim deed, getting rid of her interest. The IRS the very next day files a tax lien against her. But it doesn't attach to the house, right? Because she quit claimed it first in time, first in right. Turns out my client was lying to the IRS. They were still married. There was no divorce was ever filed. There's no divorce decree. And so the government started rattling its saber saying, we're going to sue you to reduce the claim to judgment because her half interest in the house was worth $100,000. And so she divested herself. She put this asset outside of the reach of the government. And so the government was very displeased with this, of course. And
Isn't that a legal conveyance, so they could get her on that, right?
sorry?
Isn't that like a legal conveyance?
Yeah. The question is that a legal conveyance? There's something called fraudulent conveyance or transferee liability. And so this might have been both, because if the husband was involved in this scheme, probably was, then the government can collect her liability from him to the extent that the value of the asset that she put out of the reach of the government was transferred to somebody else.
Or they live in Wisconsin and they could take the whole house.
Or they live in Wisconsin. All right. That's all I have. Do you have any questions?
Oh, yeah, I got it. On that first time abatement penalty, is that always a slam dunk if you apply, if you call, I mean, you meet all the qualifications, is that a slam dunk?
Is the first time penalty abatement a slam dunk every time if you meet the qualifications? It depends on the dollar amount. So the answer is yes, but it's how you get there. If the value of the abatement is less than $10,000, IRS ACS has online authority or the line authority to give you that abatement if it's less than $10,000. If it's above $10,000, you have to make a written request. You can either do it in a letter form or you can file a Form 843, request for abatement. but it'll get done. It's just if it's above 10,000, it takes longer.
So if it's under 10,000, you can call them up and they'll do it?
You can call them up and they'll do it right there on a telephone call, and you take that on a contingency fee.
And does bankruptcy always wipe out all tax debts, federal, state, and local?
Does bankruptcy knock out all tax debts? No, it doesn't. It has to be 1040, and it has to be old enough. It has to be 1040, and it has to be old enough. So any tax return due within the last 3 years, not dischargeable. Trust fund taxes, 100% penalty, not dischargeable. So a bankruptcy is of limited help in certain circumstances. If the IRS filed a tax return for you, a substitute for return, not dischargeable because you didn't file a tax return. You were required to do that. Any other questions? Well, thank you so much for your time.